Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, September the 11th. I want to take just a brief minute to discuss what markets did last week, as the S&P 500 was up 33 basis points on the week. The mid-cap index was the led all indexes last week and was up 1.31% on the week, and the small caps as measured by the S&P 600 were up 90 basis points. And as we move forward into this week, all eyes were going to be on the inflation reports that we were going to get this week. On Wednesday, we got the Producer Price Index, or the PPI, and that was actually off 0.1% and came in line ex food and energy up 0.3%, right in line with expectations. So nothing too crazy on the upside on PPI. And then fast forward to today, and we have the Consumer Price Index, or the CPI, that we received this morning, and it came in 1/10 hotter than expectations, up 0.4 on month over month, up 2.9% year over year. And what that did was, while it was a number that was hotter than expected, it wasn't a number that's going to keep the Fed from cutting rates potentially next Wednesday when they come out with their announcement on cutting rates. And so now you've also started to see a shift in debate between not if the Fed cuts, but are they going to cut 25 or 50? The reason why we're here and why we're rallying off of that is we've had two pretty abysmal job reports over the last 2 months, where while we're still positive adding jobs, it's nothing to write home about. And so the Fed has a dual mandate. Remember, it's not just price and inflation mandate, it's also an employment mandate. So it's inflation and it's employment, and now there's cracks in the employment, and so they're going to have to start supporting that market. And so we do expect the Fed to cut rates in September. And so that leads us to what's happening overall in the economy. What's the impact that that's going to have on the equity markets? Are we slowing? Are we heading towards that recession? Or are we moving to what we call more of a Goldilocks economy? And we'll explain more what that means in just a minute. But what we've seen is a slowdown in hiring. We've seen a slowdown in some other areas. We've also got some red flags that we're seeing with credit card debt at all-time highs, and loan delinquencies on auto loans are starting to creep up. However, if you're in the upper 10%, upper middle class and upper class and top class, you're still doing incredibly well. You don't have to worry about interest rates, and you're still getting a good return on your dollar invested in the bank and in your savings accounts. And the upper is really supporting the economy at this moment, while there are sections of the economy that are hurting. The good news for those is there are those rate cuts on the way, and if we get some clarity on tariff policy and things like that, that may give confidence for employers to reignite and restart that hiring process. But what we believe at River Place is that while the economy, yes, has slowed, and it's going at still a good pace, we are projected to grow to 2.5% GDP for the quarter, and that's a great growth rate for the U.S. economy. So you often will hear the term thrown around from time to time in investing, is this a Goldilocks situation? And so what does that really mean? What we like to just kind of break down some jargon here and just kind of give you what it means, so you know next time that you hear it on CNBC or whatever network that you do watch and get your stock news from. And what that means is it's an economy or a market that's not too hot but not too cold, but just right. So if you think about the old tale of Goldilocks and the porridge, she didn't want the too hot, she didn't want the too cold, she wanted the just right porridge. And so that's what that means in investing, is an economy that's really found the sweet spot and is doing well. And that's why you're seeing this reaction in the equity markets. Remember, the equity markets are investors betting on the future outcome and the future predictions of where they see the economy going and where they see corporate earnings going for these companies. Remember, we have a lot of productivity gains and realizations that we're going to have from AI and AI-related names. And we aren't even seeing the impact really of that yet in the overall economy. So if you have questions about how to navigate this time, or what the Fed rate cuts mean for you and your portfolio as we sit here at record highs today on September 11th. Give us a call. We'd love a chance to talk to you. You can reach us at 904-346-3460. As always, check us out online at www.riverplacecapital.com. I hope everybody has a wonderful rest of your week. Thanks so much for watching.